Having external lecturers have advantages but disadvantages. We don't know how to use the systems.
Dividends will fall.
Yes. Probably best to get that's fine.
Oh, that's fine?
Yeah, that's fine.
I think they should be in the not too sure where they would have downloaded from this one because we have a different H file in students.
Yeah. Okay.
I think the problem might be that they might, once you log off, they might make a new
Thank you very much.
No,
Hello. So, sorry it took a while to set up all of this. I hope you can see the screen well. So today I've been told that there will be some students talking about finance sustainability for the first 5 minutes, but I can't see them, so I'll just start, I guess. And if they come in, they can give their talk, or if you're here, raise your hand. So, Okay, my name is Davide Silvestrini. I work for JP Morgan. I head equity derivative strategy. I've been there for 9 years. Before then, I was in another American bank, Merrill Lynch. And 12 years ago, actually 13 years ago, I was actually sitting where you are because I studied this MSc in finance. So yeah, I have a connection, long-dated connection with the business school. And I will talk to you about 3 topics. So we'll have 3 lectures, and it's all about, let's say, advanced equity derivatives products. The first set of products we will see are derivatives that allow you to trade dividend expectations, dividend swaps and dividend options. So we will focus mostly on dividend swaps. The second lecture is in a way the meatiest one, and it's on volatility trading. Now, volatility trading is an enormous word, so that I will just give you a hint of some of the instruments that are used and how they are used, but it is what I spend at work 70-80% of my time on. So it really is a very, very vast type of topic. So there's a lot to say there. And the final lecture will be split in 2, but it will mostly be about another, if you want, tradable dimension in equity derivatives, which is correlation. So when you have an index, and you can trade both optionality on the index and on the constituents of this index, you can devise a way to essentially extract and isolate a correlation exposure and trade correlation on its own right, similarly to how you can trade volatility on its own right. But we will see it's not quite as neat as trading volatility. But the topic for today is dividends, and it's an interesting market. I mean, I essentially, when I started working in a financial industry, it was not developed at all as a product. Now it's mainstream. It's a big product, and we have a lot of clients trading it. So we will go through some basic things that hopefully you already know. So start from what is a dividend, and then go a little bit more in the mechanics of the product, so special dividend swaps, and then dividend futures. And we'll talk about why people decided that it was a good idea to trade dividends, so how this market originated, and where the dividend risk originates. So because with derivatives, you always have two counterparties taking opposing risks. So you can manufacture any derivatives risk, but what is interesting is to trade things where there is a natural supply. And so we will see what is the natural supply of this dividend risk, which emanates mostly by the issuance of structured products. And finally, we'll see a few charts on in terms of how people look at this and how these trades performed and what drives the performance of these trades. But let's start from some very basic facts. So dividends are some payments from companies, and payments from companies to their shareholders. And these payments typically arise from essentially the profit made by the business that gets distributed, but they can also arise from other reasons. For example, if a company decides to sell a subsidiary, it can then decide to distribute the proceeding as a dividend. So dividends that are out of the ordinary business are called regular dividends. Anything that is outside of the regular dividends is called, guess what, a special. And we'll see that this distinction is important because dividend derivatives settle on the regular dividends, not on the special dividends. Companies tend to try to have as predictable as possible a dividend policy. So the companies really want the investor to be quite comfortable with how much money is going to be paying out. A lot of investors, especially pension fund investors, but a lot of institutional investors generally, buy equities because of the yield that equity generates. So if a yield not only has to be high, it also has to be highly predictable. So companies generally try to give a very strong indication of the amount of dividend they will be paying, and they sometimes make some quantitative statements. So they will say, I will pay X % of my profit, so if the profit is higher, dividend immediately gets bumped. And some companies make a kind of forward-looking promise to continue to expand the dividends through time, so to try to increase the dividends amounts or at least maintain them, which is called a progressive dividend policy. So as you have certainly seen in your studies, dividends are an important part of how you evaluate the value of an equity holding. A company can be thought as a stream of payments, dividends, plus a terminal payment or whatever, terminal value of the company. You discount all of that by a risky rate and you get the value of the company. So, but dividends are also important for derivatives for a different reason. Most derivatives refer to a forward level. So most of them, well, essentially all of them. And the forward level for equity indices, unless the equity indices are total return, embeds a dividend expectation. So you've seen in your early courses how you value future, and you've seen the cash and carry argument of why the value of the future is obtained by the formula you see above, and that works for essentially options as well, because options, when you're trading options, what you're trading really is not the spot delta, but it's the forward delta. You know, the delta is based on forward. That's the real risk that you're exchanging. So if you make market in options or futures, you run a risk. You run the risk that that expected dividend figure changes, because you've made a price to somebody based on a given expectation. If that expectation changes, you will be impacted. So you will have a P&L hit that could be positive or negative. Well, it depends how the expectation changes and whether you sold or bought the contract, but it is a risk. Now, the job of a market maker is to try to hedge out all the risks and ideally be left with a nice profit, but a riskless profit. So if you trade a call option with somebody, or even if you trade a future with somebody, you're not guaranteed to be able to find another counterpart that want to take the other side. So you will warehouse that risk and try to hedge it as much as you can. So not only this, but dividend expectations can change, and or simply something can happen, so a company can decide to cut a dividend. So it might be an actual fact that leads to that P&L. So that's a risk. So banks started issuing very long-dated options embedded in structured products, and we'll see exactly what type of structures are more common later. And by doing this, they started having on their books large amounts of dividend risk. Now, this dividend risk grew to the point where it started becoming a problem. So, and people on the banks thought, okay, I would really like to sell more of these products, but the risk management told them, you can't. You have too much dividend risk. And that's the reason why dividend derivatives were invented, to recycle that risk, so that to manage that risk, so that, for example, a desk issuing structured products could continue to issue structured products and use this dividend swap or dividend future to remove that risk and so forth, and therefore make the risk manager happy and run a position which is more sustainable and less prone to blowing up spectacularly, which, by the way, it did in 2008. And so that's the reason why dividend derivatives were invented. And the first dividend derivative to be traded was a dividend swap. So a simple contract between two counterparts to exchange an expected dividend for the actual realized dividend over a period of time. So the seller of the dividends provides the realized dividends to the buyer of the dividend, and the buyer of the dividend essentially delivers the implied dividend level, the pre-agreed strike, if you want, to the seller. These contracts do not have any cash flows before their terminal date, before their expiry, and are cash settled. So the first swaps were introduced on single stocks, and then they were extended to indices. The majority of the natural dividend risk is actually on indices rather than on single stocks, because the majority of the structured product issuance is on indices. Oops, sorry. So some of the aspects of dividend swaps. First of all, there's two legs. One is the realized leg, and the other one is the implied leg. The implied leg is the pre-agreed strike of the swap. The realized leg amounts to the sum of all the qualifying dividends that are realized over the life of the swap. So over the life of the swap, so say we have entered a dividend swap on a given company, on Total, we have pre-agreed, the implied leg will be the pre-agreed level, or the market expectation really, on what the payment of the company will be in dividend, in terms of dividends over a period of time, and the realized leg will be given by the actual payment that the company makes. The buyer of the dividend pays the implied and receives the realized, and the seller receives the implied and pays the realized. So there will be a P&L, so there will be, the swap will pay something when obviously the market expectation turn out to be different than what is actually realized. So if the market expectation was perfectly in line with the actual realization, the swap will pay zero, but it's kind of fairly intuitive. The swap dates. So inception is when you trade, very simply, when you the date when you initiate a contract. The start date is the date at which you start accruing the realized dividends, and the end date is the expiry of the swap. Dividend swaps, unless they settle on the current year, they are forward-starting instruments because the start date for the accrual of the dividends is typically in the future. And dividend swaps are typically constructed or quoted to capture the dividends over a given year, an yearly period. But there's a slight complication because the yearly period does not start with the 1st of January and with the 31st of December. It goes from the third Friday of the December of the year before to the third Friday of the December of the following year. Now, this might seem very strange, but there's a practical reason for that. That is the December expiry for listed options in European markets and US markets. In Asia, it's slightly different, but the contracts essentially capture 1 year between the inception is the day after the expiry of the December option, and then the contract covers the entire period from that day to the December expiry of the following year. So in this example, you see, for example, for 2014 dividend swap will include all dividends going ex between the 20th of December 2013, so the day after the expiry, or the third Friday, and the 19th of December 2014. So the day of the following year expiry for December options. So more just pictorially, forward starting contract. So you trade today and you have exposure for a range for unrealized dividend on a range of days in the future. So if you want exposure to all the dividends from now to, say, 2020, what do you need to do? So if you buy the 2020 dividend future or dividend swap, you will have exposure from DAC 19, December 19, to December 20. So if you want exposure to all the period, you have to buy all the dividend swaps from now to 2020. In Asia, there's a different convention for the calendar dates, especially for the Nikkei. For the Nikkei, there's dividend uncertainty up until March, so the year is kind of lagged, and contracts go from March to March, but it's kind of a minor point. So the payout is really very straightforward. There's a notional amount, which for single stock is typically expressed in number of shares, and then the payout is given by that notional amount times the difference between the realized dividend over the period we consider and the implied dividend. Simple as that. And there is a small example here that I will not go through. It's quite basic, but it gives you. It's more for you to go through it at a later stage when you are revisiting the lecture. So I mentioned qualifying dividends. So not all dividends are included in a swap. Why? Why people have decided to complicate their lives? Well, when a company, say that a company decides to split in two, okay, and to sell part of their business to another company, and then they pay out to the shareholders this very large amount of money. So that would certainly be a special dividend, and it it's also a dividend that would trigger a restriking of existing option contracts. So if you have an option contract, that option contract will change after this special dividend because you consider a major corporate action. And for major corporate action, in order to remove the risk of the corporate action risk from holders of option, the strike of the call and all the parameters of the call or the puts will be adjusted. For a normal dividends, they would not. So that's the reason why special dividends are not included in a dividend swap. Because for the market maker that makes marketing derivatives, special dividends are not a risk because the option gets adjusted. So this means that the option gets adjusted so that you don't have a P&L impact for that event. But that is only for the specials. So the dividend risk arises from dividend payouts that do not lead to an option adjustment, which are the regular payouts. And an ordinary dividend would lead, obviously, to would have been incorporated in the pricing of an option, and therefore, if that turns out to be different from expected, that leads to a risk. The special dividends cannot be forecasted. Yeah.
What if a company is impacted by a one-off loss and the regular dividend is impacted as well? Is it considered a special?
No, it's not. That is a cut of the regular dividend, and it does happen. So if a company doesn't have money to pay a dividend, then what will happen? And they decide not to pay the dividend, then if you bought a dividend swap, you don't get anything. So if you paid something for that dividend swap, you have a loss. What is interesting is that the dividend swap market will hold an opinion on this risk precisely. So you will find that the implied dividend on a company that has a very unsustainable dividend will trade at a big discount because people will have, essentially the market will have an expectation that this dividend is risky. If a dividend is 100% safe or considered 100% safe, then the market will not apply any discount or very little discount. So a cut in a regular dividend fully impacts you in a dividend swap. It's not considered a special. Only divestiture of business typically are considered a special, as a broad kind of. But it is actually something that is decided by the exchanges and by the index providers. So there are broad indications, but it's actually a point can be debated. But what you should remember is something that is not regular and it's a one-off that leads to an adjustment of the option, and that is not included in a dividend future or dividend swap. And so regular dividends are included in a dividend swap. They're typically included as gross, so without considering any tax. And there are other type of dividends that get included. So scrip dividends. So scrip dividends are regular dividends where the shareholder has the option of either deciding to get more shares or some cash. If you have the option to get some cash for the sake of dividend future, that's a regular dividend. And also another, and that's the last, is a pretty kind of obscure case, but another case where actually the dividend is considered as a regular is a payment in shares from the company where the shares are not newly issued, but they already existed. They were sitting like in the treasury of the company. Because if the company issues new shares to pay a dividend, well, it's actually not paying out anything, right? It's diluting you. So the economic impact is zero. But if the shares are pre-existing, then it's an actual payment. It's an actual distribution of value to the shareholder. Mark to market. Now, again, very, very simple. We have our notional amount, and the mark to market is simply given by the difference in the implied dividend level, the strike, at the time t when you are marking to market, minus the implied dividend level at time 0 when we initiated our trade, discounted by the discount factor. So very, very straightforward. And dividend swaps are OTC. So you need to have an ISDA agreement in order to be able to trade a dividend swap with a counterpart. You take some credit risk with that counterpart, and more and more people are steering away from having this kind of transaction unless they really have to. So what is being traded more and more are dividend futures. Dividend futures are contracts that are listed in an exchange, in a market. And when you trade a dividend future, you actually face the exchange, so you have the credit risk of the exchange. The mechanics and the payoffs are very similar, but dividend futures essentially are the only thing is that with a dividend future, you have to essentially post a margin like you do for every future. So you post an initial margin when you trade, and then if the trade moves against you, then you have to post more money to maintain that position. And this is to in order to guarantee your solvency, that you will be able to pay at the end if the position goes against you. And a lot of the trading happens on indices, but there's also dividend futures on single names. By single names, I mean single stocks. So how do you? So it's all very clear when you're trading a swap on a single stock. The notional amount of our swap will be the number of shares, and then the strike and the realized dividends will be in dividend per share. So all very straightforward. But what do you do with an index? It's also very straightforward, but in this case, you have essentially to consider that there is a standardized contract size, and then that the realization and the implied dividends will be traded in index point. So first of all, the standard size for the Euro Stoxx 50, which is the most actively traded dividend future globally, the one index point and the size of one contract is 100 euros. And so if you trade 10 contracts, your notional exposure will be of 1,000 euros. Very simple. And so the slightly trickier bit is how do you calculate these dividends in index points. And in order to understand that, let's take a step back. I know it sounds very basic, but let's see how you calculate an index. You would be shocked to know that if you go around in a trading floor, and maybe you go outside of the traders and to some of the salespeople, and you ask them, how do you calculate an index? Some of them get very confused. So this is basic, but it's also important and stuff that people get confused about. So, first of all, what is an index? An index is a number, a level, that represents the performance of a number of stocks. And indices, most indices are built essentially to represent on this basis. You sum up the market cap, the market capitalization of all the stocks within the index, and then you divide that by an arbitrary number, which is called a divisor. And the divisor helps us in two ways. First, we don't really like to say, what's the level of the S&P 500? Oh, it's 32 trillion point, that would just be too lengthy to say. So the divisor just takes it to a number which we can deal with easily. We like to work with small numbers, just being human. And secondly, it has another important factor, an important role. It guarantees the continuity of the index when there are changes. So say that you want an index that through time, if you take two different levels and you just calculate a return based on these two different levels, you want something that represents an economic investment in the underlying strategy of the index, which is buy the shares that are constituents and hold them. So if if we didn't have that divisor number, which changes through time, and we decided to remove one stock from the index and add another one with a different market cap, we will have a change in the total market cap. But that change in the total market cap does not reflect an economic impact for somebody following the strategy. It just reflects the fact that we chose to take away a share and put another one in. And so we use the divisor to guarantee continuity on this change. So the divisor is adjusted so that on the time when you implement that change, the index level with a new share, new shares, new composition, and the old composition is the same. So the index level is not impacted by the fact that you decide that 3 shares are going out from the S&P 500 and another 3 are going in. And another small nuance is most indices are free float adjusted. So you have, in order to calculate the total, the market cap of a company, you take the number of shares, you adjust it by free float, and then you multiply it by the price of the stock on that day. Why free float adjusting? Because that's what you can actually trade. So in most developed markets, it's not a big deal, but there are some markets where only a small part of the shares can be traded. The majority of the shares are held by, say, government entities, and they cannot be traded. So only a subset of the shares that exist on that company can be traded, because the rest are held by if you want, strategic investors and cannot be sold. Even here in the UK, you have the example of the banks that were bailed out. You have the example of Lloyd's that used to have a part held by the government. So the shares held by the government were not part of the free float. The free float is out there to be can be sold or bought in the market freely. So to calculate an index, to recap, you take the number of shares, free float adjusted, and then multiply that by the price of a stock. You do that for all the stocks, and you get the market cap of all the stocks, and then you divide it by the divisor, which is a number that, well, you just get it. It's an arbitrary number. if you want to calculate the dividends, you do exactly the same. But instead of using the price, you use the dividend per share. So instead of using the price of a company, you would use the dividend per share of the company. So if we want to calculate all the dividends points that say this is the Eurostoxx 50 index, so will pay out on a given over for the contract for a DEC 15 contract, so December 2015 contracts, we take for all the shares, we take the free float factor, number of shares, the dividend paid, and then we repeat this calculation for every single day. So because most day company does not go ex-dividend. It typically goes ex-dividend either 2 or 4 times per year. Some companies only once. So you just sum over everything and you get your dividend points. So risks to index dividends. Well, simply that companies cut their dividends, that's a risk, clearly enough. But there are also some other risks. So there's a risk of index reconstitution. So indices are built on a set of rules. And if the company does not comply with these rules anymore, then it's kicked out of the index. So that there are rules on changes that get applied to indices. And this is actually an area where we also make research. So the investment industry researched this. So you want to, if you can, know before the rest of the world what stock will be added to the FTSE 100 or to the Eurostoxx 50, then guess what? You have a trading advantage. You can buy the stocks before everyone else. The reason is that, especially nowadays, a large amount of money is managed in a completely passive way. So tracking a benchmark. The trackers, what they have to do is, when the stocks get added to an index, they have to buy it. They don't have a choice, they just have to buy it. So if you can forecast the change before anyone else, then you can essentially pre-position and make some money out of it. Or if you're a tracker and you're trying to be particularly smart, you can actually start trading before it's finalized, just because you know that it's highly likely that a stock will be added. And this is called indexation, and it's actually an area of research. Not the most thrilling one, admittedly, but there's good business that gets done on the back of this. So, but reconstitution risk, so the risk that a stock that is in the index gets replaced also applies to dividend futures. Because always say that a stock that pays a very large amount of dividends gets kicked out of the index, and another one that doesn't pay anything gets added, then obviously the overall dividend amount will be lower, and that's a risk. Another bizarre but actually quite real risk is a timing risk. Some dividends are go X, so get paid if you want, in the proximity of one of the expiries, or of the December expiries. If for whatever reason the company decides to shift the date by a few days, the dividend drops out of a contract and gets into another one. So we had it's funny, well, it's funny, it wasn't very funny. We had Royal Dutch 1 year, there were 5, it pays quarterly, so there should be 4 per year. There were 5 dividends in one contract and 3 in the next one. So obviously, some people are very happy, some people are not so happy about what happened, but it's a risk, something that you have to consider. So the futures for ease of settlement, they settle on an index that gets published, and this index just accrues, sums up all the dividends that have gone X. So, and it looks like this. Actually, this is the realized dividend index for the Eurostoxx 50 in blue and for the FTSE 100 in black. The index increases, summing up all the dividends that go X on a given year, and then reset to 0 after the expiry, and then sums up the dividends again. So it is what it is, but we can see also some trends. So before the credit crisis, Eurostoxx 50 dividends that were already trading. The FTSE dividends, not really. They started trading later. And initially there was a good growth year on year of the dividends, and then boom, it crashed down. And then it resumed to some degree, but it's not really that crystal clear. FTSE 100 dividends have been growing fairly steadily. Why is that? Because FTSE 100 companies tend to be much more defensive companies generally, and a lot of these FTSE companies have a progressive dividend policy, so they aim to increase the dividend year on year. You can also notice that 2018 has been a lot higher than 2017. So why is that? So everybody was. What has happened is that with the referendum vote, which you certainly all heard about, the pound got essentially smashed. So the pound got destroyed, and a lot of FTSE constituents are actually multinational. They are not really UK companies. So they earn in dollars, and a lot of them also pay in dollars. So given that the future settles in pounds, then that mechanically took up the level of the future. So how does a dividend future behave leading into expiry? So you can see that before expiry, so here you have the settlement value of the future. They don't really matter until you get to the settlement point. So it's nice to see the accrual throughout the year, but for the sake of the contracts where it doesn't really matter what they do before, and you can see that dividend future end up converging to that level. And you can also see another thing, that the further away you are from settlement, the more the dividend future seems to be volatile. So the point is quite simple, and we'll see it later. It's what people refer to as call to par or call to realized. So the closer you get to the expiry of the contract, the more visibility and certainty you have on what the actual dividends payment will be. Therefore, the less risky the expectation, and therefore the expectation should be less volatile, and the discount compared to the final expectation should also be lower. I'm not sure how you want to do in terms of breaks. So what's the time, first thing? Okay, it's been only 50 minutes. So we can, what do you prefer to do? Should we do a break? You want to do a small break now, or should we should I go on a bit more and then we have a break at around half an hour? Voting, half an hour? Now? It's balanced. I don't know. Let's toss it. Okay, half an hour. Let's keep going for a little bit more. So, equity, futures, and dividends. Now let's take a step back again. We've seen these two products. We've seen the dividend swaps, and we've seen the dividend futures. So let's come back to, just because this will lead into the following part of the lecture. So future, as we've seen before, and this is more of a recap. You can price them just by knowing where the spot level is, the rates, and then you have that dividend expectation. Now, maybe as a little aside, it's not actually that simple, because the cash and carry argument works, but in the real world it works a bit differently, because you have more moving parts. First of all, what is this risk-free rate, this mythical risk-free rate? If I am a trader in a Delta One desk, do you think that when I borrow money from my treasury, I get it at some kind of risk-free rate? No, you don't. You get it at LIBOR plus a spread, and these spreads will reflect the fact that JP Morgan, or whatever bank you work for, has some funding costs. So if JP Morgan wants some capital to invest or take risk or make markets, actually they have to compensate people for the risk that he takes and they are taking, and therefore that risk-free rate is not a risk-free rate, should be risk-free rate plus a spread, and then so it should be actually a true funding cost, and that is another element to a forward. This is also helpful for if you're doing interviews, because one of the things where people in the industry try to pick you when you are still in university is on these nuances, right? Because they say, oh, everybody knows the formula for futures, but can you trust this? What is this? What is that number? And what does it mean in practice? At the end of the day, these are not kind of theoretical exercises, and there's actual transaction behind it. So you have to think what this transaction is about. So you are essentially borrowing some money to buy a stock. So the risk-free rate cannot be really the treasury rate, for the simple reason that you are entering a risky transaction, and therefore whoever lends you the money will want to be compensated for that. And that could be an external investor, that could be your treasury. Then you have the dividend expectation, which as we've seen is a risky one. So it's we don't know for certain unless, well, sometimes we do. Sometimes we know that the companies announce the dividends ahead of time, and so you actually know exactly what the dividend is. But most of the time, that will be an expectation, and a risky one that can go both ways. And then when you hold shares, you can also lend them out and get a yield for that. So if you want to short a stock, you have to borrow it from somebody, and that somebody from which you're borrowing the stocks will want a rate of return. So the forward embeds also that rate of return, and so you should adjust it also for the borrow. But coming back to our simplified world, given that we're talking about dividends, the main risk on a forward, and if you make market on forwards, is on the dividends. Now, if you make market on options, you still have exposure to dividend risk. And you can think of this in terms of put-call parity. So essentially, when you're trading puts and calls, the delta that you're trading is not spot exclusively, but you're actually trading a forward again. So if you make market on calls and puts on a given stock that pays dividends, you will have dividend risk as well. And that's put call parity. As you should know, it essentially states that if you are long a call and short a put, then you've created a forward synthetically. So you've created, if you take your stick diagram, you take one stick that is like that, which is the short put, and one stick that is like that is the call. You put them together, same strike obviously, and you obtain a linear payout. And that linear payout is a synthetic forward. So if we construct synthetic forwards in the option market, do we get the same dividend levels as the dividend swap and dividend implied dividend market? Well, pretty much we do, yeah. So this is an example as of 2008, which was a particularly distressed time for dividend markets. And you can see that the level that you obtain by put-call parity is very, very close to the level that of the prevailing dividend swap. Now, 2008 was in a way was crucial. 2008, 2009 were crucial for the story of the development of dividend contracts. Because there was as you know, there was a great financial crisis that led to all sorts of problems, and it also led to a large amount of distress on dividends. Now, before the great financial crisis, many trading desk in banks, so up until 2007, 2008, did not hedge in full the dividend risk they had from selling structured product. Because this position, this long dividend position, had a positive carry. So for them it was like, oh, it's a nice positive carry, let's keep it on the book. And the amount of risk they had was actually large. And the perception of the risk was that it was very small. The perception was that really companies don't like cutting their dividends, so the amount of risk that emanates from these dividends is very, very limited. Then the financial crisis arrived, and especially banks started cutting the dividend to zero. And so what happened was a sort of perfect storm. The perfect storm derived from this. Dividends were free-falling, the realized dividends were free-falling, and all banks had done the same. So all trading banks in all the major banks were very long dividends. So there were, at the time, you could trade dividend swaps, but the only listed product that you could trade were the Eurostoxx 50 dividend futures. And so soon enough, the trading desks were forced hedgers. They had to cover that risk. The risk manager told them, I don't care what price, you just get rid of that. Right? That was the message. At that point, you just have to go in the market. So you are long the dividend. So guess what you do? You sell the only liquid product that's out there. They sold the Eurostoxx 50 dividend futures, and they sold so many of them that they took the dividend futures level to levels that were absolutely ridiculous. So they took the dividend futures level they were trading around, before the crisis, 150, they took it to 60. So a reduction, an enormous fall. Now, if you did a little bit of kind of basic calculation of how bad this could be, these numbers were absolutely outrageously large. So we were talking about discounts compared to even pessimistic expectation of 60, 70% of the fair value. So, and this is exactly when institutional investors started to get interested in these dividend futures, because they said, this just looks too good to be true. If I'm able to take the other side of this trade, it was done mostly by hedge funds, but also by institutional investors. Then I have an expected return which is enormous, and my worst case scenario, I mean, best case scenario, dividends go back up to 130, 140. Worst case scenario, they go to 0, but I can only lose 60. So the risk reward was absolutely stellar. And once hedge fund and institutional investors started to get into the market, the dividend level found a floor, and then they went back straight up. And if you remember the settlement level for 2009, yes, it was lower, but it was not like for the Euro Stoxx 50. So that would be, sorry, I need to find something to point to it. Well, you can see that it's the one just before the 2010. It was well above 100. It was, if I remember correctly, about 120. So essentially a great trade. And then people said, yeah, this is a nice instrument, and they started trading more actively. And the crisis had the effect of really making dividend trading or trading dividend expectation a lot more broadly accepted and followed by the markets. So before going to the final part where we will talk about the origins and evolution of the dividend products and structured products, maybe we'll take that break, even if it's not exactly half an hour. No, actually just 7. So let's take 10 minutes break.
So I've done higher management and so I just did that. Oh, really? Got all of the details. I skipped Yeah, so I think I watched like 17 movies last year. It didn't seem so. No way. 17 in a week. That's a 2.5 movie a day. And these movies are long as well. But the first ones are like 4 hours. The original. Oh really? He actually Oh, they sent you a link on Discord, were you envious of your cousins at the meetup? Have you ever played what you do is you just run the rest of but so you like take that how much you grade like I remember it's like the biggest one of
volevo chiedervi una cosa solamente. Hai detto che prima nel 2008 i disco issue avevano structural products, erano tutti lunghi dividendi, i desk.
Sì.
Io non capisco perché
Adesso lo vediamo, la seconda parte della lezione è proprio su quella. In realtà no, perché praticamente tutti i prodotti strutturati portano rendono quasi tutti i redo di destra.
No, perché stavo pensando, cioè quando uno è short, se io vedo tutti sono short dividendo.
Sì, però le banche diventano lunghe, no? Le banche sono, cioè d'altra parte.
Sì, il cliente vende tutto, quindi
la maggior parte del rischio deriva da quello, dagli autocollogo specialmente. Sto andando un po' più veloce, un po' troppo veloce probabilmente perché è solo un'ora. Non so se avrò troppo, secondo me è un'altra ora cosa si fa anche. Bene.
Oh yeah, okay. That's Chris Hunter. The Avengers movies, I love the new one. He's in that's what I'm rewatching. Oh yeah, I've seen all of them. Except for like the last ones. Like I've seen four of them. That's Lord of the Lies. What do you do? Have you then daily, right? You gotta do it every constant day. You know you can get like super bad infection, or bad infection. Yeah, if you don't push much, you can like infections. Yeah, but like I see my infections are not something like that. So there's take like a photo inside. Yeah, again, that's how I but I did it too, put on your glasses. We're not to actually go down the deep. Yeah, but that movie actually sees time in the last movie one. Again, something like white. Look at the first Spider-Man film, the last franchise. That's how I think it's really like you see it like it's like easy. So like when I right, then I had like a really good. No. you have like in that moment, I sold at the time like when I was I could actually like say how long it was and like randomize it logically as I was going. That doesn't happen.
Okay, so maybe let's resume. So let's get back and discuss the last few topics of the lecture. So the second part of the lecture will mostly discuss about the supply of dividend risk. I mentioned structured product. We'll see exactly how structured product lead to the supply of this risk to the market. And then we will see a few further facts on the more practical facts about dividend expectations and dividend futures, and a few charts of how people actually look at these products and how they evaluate whether they're good investments or not. But first, a bit of history. So structured products were they have been issued through time. So already in the 90s we had a number of structured products being issued, and towards the end of the 90s, because of essentially the risk deriving from structured products, people started to trade dividend derivatives. So the first counterparts, then that's quite typical when a bank has a new product, or the first counterparts tend to be hedge funds, so they tend to be more flexible in terms of what contracts they can enter, and it also tends to be, if you want, more technical in terms of understanding the nuances of derivatives most of the time. A lot of people in equity derivatives based hedge funds, volatility hedge funds, are former banks traders or people that worked in banks before, or researchers or strategists. So that's typically the first point of contact. And the initial products were OTC. And then after the introduction, when the market develops and becomes bigger in size and more standardized, then what generally happens, and what happened also this time, is that institutional investors also start to get involved. Now, we're at a point where we also have private bank investors, and I wouldn't say retail investors, I would say private bank investors, or say wealthy private investors that trade the dividend expectation quite actively. So on top of, I spend a part of my time to cover the space, so to have a view on dividends and to recommend trades on dividends. Amongst the various investors that I cover, there's also the private banks, especially in the US. For example, our own private banks is quite interested in clients that trade a lot of this. So it starts from a product for hedge funds, and then it branches down and it gets more widely accepted. That's what happened with dividend expectations. But coming back to the structured products, so what are these structured products? So structured products, what I mean by structured product here, and then it's a wider word, I mean equity-linked product. So products that have a payout that is linked to the performance of equities, and typically these products embed an option of some sort. So and they refer either an index or a basket of indices or something else. So the payout of a structured product, let's say that it refers to the Eurostoxx 50, it refers to the price of the Euro Stoxx 50, which excludes the dividends. So, so when you're buying a structured product, you're buying something that is linked to the forward, the future level of the Euro Stoxx 50, not to the performance, not to the stream of dividends that the index will deliver. When you're buying a structured product, you don't receive any dividends on the index. You only have a P&L or an exposure payout that is linked to the price return of your underlier. There's simplifying to the extreme, there's two main categories of structured products. Capital protected products and capital at risk products. The simplest capital protected product you can think of is a bond plus call. So investor gives me 100 euros. With this 100 euros to enter a 5-year product where he wants the market participation. So I go in the fixed income market and buy a zero coupon bond with part of this money. So let's say that the zero coupon bond costs 95 euros. Well, nowadays with the rates as they are, it will cost even more. And so of the 100 euros that I have, I'm left with 5. So the zero coupon bonds will guarantee that we return the capital at expiry to the client, because the zero coupon bond will mature at 100 at expiry, and so we give that money back to the client. And then we with the remaining 5 euros, we buy upside. We buy a call option on our index. And the point is that depending on how expensive these call options are and on essentially how much money we have left after buying the structured products, we will buy more or less participation on the index. If you say that you have a participation of 100%, if you have bought a notional exposure equals to the 100 euros that were given to you initially. With the rates where they are now and credit spreads where they are now, achieving a high participation is not possible. So these products are not particularly popular currently. They were popular when rates were higher. So they were popular when rates were around 5% and volatility was relatively low. At that point, you could get participation of 200, 250% on some structures. Then you can play with a number of terms and parameters to make it more attractive. Obviously, this is just a very simple type of product. But bottom line, if the clients buys this capital guaranteed note from a bank, the bank it leaves the bank short the call, a 5-year call on the index, because the clients have bought from you a call, you're short a call. You take the other side of the trade. So nowadays, capital guaranteed products, they are not very popular. What are very popular are reverse convertible type of products. So reverse convertible types of products are capital at risk products. So you're not guaranteed to have your 100 euros back. An investor still gives you 100 euros, and you still go and buy a zero coupon bond, but then the investors also sells a put option. Typically, this put option is an at-the-money put option with a knock-in level. So you've seen barriers, so you know what a knock-in is. So it's an option essentially that does not exist until a given level is reached. And if the barrier is continuously observed, then the level can be reached at any point in time. If the barrier is European, then you only observe it at expiry. So the client given you 100 euros, you have bought a zero coupon bond, we are still left with 5 euros. The client have sold the put option that say that the value of the put option is 10, and so you have 15 euros. And these 15 euros you distribute to the clients in the form of coupons throughout the life of the product. So this is sort of pays out similarly to a bond. And what happens to the client? So the clients will receive his 100 euros at the end from the zero coupon bond. He will receive the coupons throughout the life of the option or the contract, but he sold you a put option, so with a knock-in. So the client potentially has a large liability due to this put option if the market falls sufficiently to trigger the barrier, and if at expiry the market is down by 30% and the barrier was at 20%, then the client must pay the other side, so you, 30 euros. So the capital is at risk. So why are these products so popular right now? Well, we have been living for the last few years. This is slowly changing, but it's very slowly changing, in a world where finding yield was very difficult. So because of the low interest rates from across in most developed countries, and because of the tight credit spreads and the quantitative easing programs, the amount of yield that essentially you could get from buying bonds was quite low. And a lot of investors need this yield, and a lot of investors like to have this type of payouts that provides coupons and provides yields through time. So up until recently, volatility was relatively elevated. Now it's not. It's actually quite low currently, but up until quite recently, volatility levels were elevated, which made options expensive. So selling puts generated a lot of yield, and it was one of the few ways to generate yield. So these products have been really very popular. They are quite popular in the European market. They are also very popular in Asia. So the Korean market is huge in terms of the issuance of structured products, in terms of notional amount. And so coming back to the Eurostoxx 50, and I know that I always mention that, but it is the biggest European index. A good part, well, not the majority of the issuance of Eurostoxx 50 products comes from Europe, but a good part of the issuance is actually out of Korea, because they use it as one of the underliers, one of the indices in their structured products. And why is that? Because they like generating these yields continuously by selling volatility, selling puts. So how does this flow leave banks? It leaves banks long puts. So let's say that, generally speaking, banks are left from the issuance of structured product long puts and short calls. If we take the argument of the put-call parity of or if you want the argument of the synthetic forward, then banks are essentially short forward. And if you are short a forward, then you are short the stock and long the dividend. And there you go. Very simple. But the interesting point is that the main type of structured product issuance, capital protected product and reverse convertible, both leave bank long dividend risk. I got a question before from one of your colleagues. So is there any offsetting in the structured product market in terms of the dividend because of the different type of issuance? Not really. Most of there are other products, admittedly, but in most cases, the biggest flow leave the banks net long the dividends with the need to hedge. So how do you hedge the exposure? Which you got by, here is a reminder of put call parity again. So you hedge this exposure by trading some, you could trade forwards, would be even more effective. You have a forward exposure, but when you're trading a forward, you can actually decompose the risk of the forward. You can say, okay, fine, the forward, what risk do I have? I have a spot risk, if you want. So just the variability of the stock price that I can trade easily by trading the stock or by trading the index in the short term. Then I have an interest rate exposure. There's a very liquid market of swap in interest rates. I can take care of that. And then I have the dividend risk, which I can also take care of by dividend swap. Then I mentioned that forwards really embed some other risks, and there's another market which is called the funding market or borrow market, and you can also trade that in order to get rid of that risk, which is slightly more esoteric, but also traded. But bottom line, what happens here is that bank is longer put and shorter call and rearranging put call parity. You can see that. You can see in a formulaic way what I stated with words before. You short the stock and long the dividend. So this is yeah, a bit. I guess I kind of preempted this slide before when I talked about the evolution of the products, and so banks are long this risk. They create a product to recycle this risk, to sell it initially to the hedge funds. Then people get excited about this product, and institutional investors get involved also, and even retail clients get involved. Yep.
If the bank hedges going along futures on the underlying, and it's able to hedge the interest rate risk inside the future, isn't the future already hedging the dividend risk?
Good question. The future does hedge a part of the dividend risk, and it's true. On an index, you would not buy the underlying basket, you would buy a short-dated future. So the point is that the structured product has a 5-year tenor. So when you issue a structured product, you have dividend exposure from now to 5-year time. The liquid future that you use for hedging are in most cases quarterly, or either quarterly or monthly. So on the Euro Stoxx 50, on the S&P, on the Nikkei, they're quarterly. So, and the liquid one that you can trade in the market is the front one. So so you would roll the exposure of the front contract. That future embeds the dividend expectation, but the dividend expectation only for the first 3 months. So you are exposed to what happens to all the rest of the curve that can change through time. So, but that's true, there's a partial offset. But it's a matter of the tenor of the two forwards, if you want. So the future is a forward exposure short term. The structured product give you a forward exposure longer term. If you find somebody that is willing to to take away completely your forward exposure long term, happy days. I mean, you are left with no risk, but you have to find essentially that. And in reality, for ease, structured product desk and exotic desks tend to be the desks that make market on these structured products. Why are they called exotic desks? Well, because they deal with options that are not vanilla. Vanilla are the standardized options that trade on an exchange. Exotics is any derivative that has a component that is not perfectly hedgeable or that has discontinuities. Given that a lot of these products have barriers or have conditional coupons, so in reality the most common product is not a straight reverse convertibles, but is what is called a not-to-callable. A not-to-callable is the client still sell you a put with a knock-in, but it gets in exchange a conditional strip of coupons. And the condition is the following. So if the typical structure in Europe is every year we measure whether we are above a certain level of the index, so if the index has returned or rallied. If the index has rallied to that point, then the product will pay you a coupon, but will also redeem. That's why it's called an auto-callable. And so the product does not even arrive to expiry. It pays the coupon and redeems early. And why do people introduce this feature? Because by doing this, they can offer higher coupon. Because in reality, in expectation, an auto-callable with 5 years of life, the expected life of the auto-callable is shorter. So what is happening is that's a shorter dated option. The coupons that you're offering are shorter dated, and therefore they're worth less, because the options that are shorter are worth less. So if you want, it's one of the several variation that allow the creation of a product that is at least optically superior. Then in reality, risk is what it is. Risk is risk. So a lot of these nuances only add value from optically. So the client sees a higher coupon, thinks it's worth more, but in reality, if the fair value of the thing is what it is, fair value. So it doesn't really add that much. But it's the most common factor. So given, and sorry for the detour from the main point that I wanted to make, but given that you have all these additional, if you want, elements in the structure and in the optionality of the structure, the type of risk that the structure entails is not straightforward vanilla that you can trade on an exchange, but is exotic. And so there are specific desks that manage that risk. And these desks tend to be the one that take the most dividend risk in banks, together with Delta One desk. That, guess what? Delta One desks are desks that trade derivatives that give Delta One exposure, so upside and downside, so linear exposure to the underlying, and so essentially very large position on a forward, and that will lead to a lot of dividend risk. And exotic desks, because of the issuance of structured product, also take this risk and have all sorts of other risks, which we will see in the next, especially in the last lecture on correlation, because a lot of risk that exotic desks take is on correlation, which is another thing that blew up spectacularly in 2008, by the way. There's a lot of things blew up in 2008. It was not a very pleasant time to be around, but it was interesting. Okay, so this slide reformulates essentially and restates the point that if you have a forward and you just trade with the stock, then you are left with a dividend risk that you have to hedge. And that's the main point. I mean, the main point is this is if you want, the main takeaway is this. There's two main type of structured products. Both leave banks long dividends. Banks have to hedge these dividends. Or if you want to take the other side of the argument, this issuance lead to a natural supply of dividend risk that has to be recycled. In order for banks to sell this risk to hedge funds, they have to sell it cheap. Otherwise, the hedge fund will say, no interest, I won't buy it. So the natural supply that exists of this dividend risk leads to a market where dividends tend to trade at a discount to expectation, and so tends to be an interesting investment because there's natural supply. So you have to comes out, have to recycle. So yeah, again, this is a bit of a repetition. And this, again, sums up the same point. So sorry, this is very lengthy, and I think some of this is possibly unnecessary. That's a little bit more interesting. So, talking about different markets. So, US versus Europe and Asia. I mentioned that Europe is a market where there's a lot of issuance of structured products. In Asia, there's even, as a proportion to the size of the market, it's even larger, especially in Korea and in Japan. To some extent in Hong Kong, on the Hang Seng and on the HSCI, so the China Share Index, but most of it is most of the issuance is in Korea and in Japan. How about the US? Well, the US is not really a very large market for structured products. Why is that? I have my own explanations, but I'm not sure they are widely accepted. And they're more like behavioral rather than anything else. You can simply say, well, it's a fact. I've actually counted all the products. I know there's less as a percentage of the size of the index. It's a fact. You can't argue with facts, right? It is what it is. Why it's like that? In my view, because the European and the Asian investors are somewhat less prone to taking outright equity risks than the US investors. It's really almost a philosophical matter. For the US investors, they follow the equity markets very closely. They follow individual companies. They're very opinionated about what to trade and what to buy, and they all like to think themselves as a sort of mini Warren Buffett. The European investor is not like that. The European investor wants a bond-like investment, and so also because the European investor historically, when they bought, at least in some countries, when they bought equities, they haven't really performed necessarily as well as the US investor. So there's less of an equity culture, and there's more of a fixed income culture, and in my view, this explains at least part of the differences between these two markets. But the reality is that it's just a fact. It's just a fact. There's also another element, which is in the US, you have other flows on long-dated options, which are absent in Europe, by and large. So you have some institutional investor and some actually insurers that tend to buy the long-dated puts. So, and that, as we mentioned before, that the issuance of structured products lets mixed bank long puts, so that is an offsetting flow, so that some of the risk will be recycled to these investors that do this type of trade in the US. In Europe, you don't have that flow to a great extent. You rather have, lately you have some buying flow from pension funds. It's one of the trades that of long-dated call option in Europe, partly because they are really, really cheap. So they're really low. So if you look at the chart of the volatility of long-dated call options, and if you look at the chart of the premium that you pay for this call option, it's really low by historical standards, and it's one of these times where I think it's a very neat trade. You're buying. It's an option that is historically relatively cheap. So you're not entering it at a particularly expensive time. It gives you protection compared. It seems paradoxical, but being long a call option is actually less aggressive than being long the stocks, obviously. You're protected to the downside. I mean, synthetically, it's like being long a stock and buying put. It's the same thing, right? So the exposure you have is the same. And there's a lot of debate where we are in terms of the economic cycle. Are we very late cycle? So are we close to the point where everything turns and we get a recession or not? I am in the camp that we are not that close to that point, but admittedly in the next couple of years we will probably get to that point or close to that point. So it's not such a bad idea to switch from being long equities to buy a call option that's historically cheap. It's not a bad thing. But that said, this type of flows are not large enough to offset the issuance of structured product, which remains the dominant force also for volatilities. We'll mention some of them in the next lecture on volatilities and the dynamics that really impact volatility. But what drives dividends is also quite fundamental. So, can company pay dividends? Are a company willing to pay dividends? Generally, they are, but at the end of the day, the company also has a choice. So rather than paying more dividends, they can buy back their shares. This is happening increasingly in the US. So in the European market, we have less buybacks. In the US, buybacks are a very, very large phenomenon. So this year we're expecting 800 billions, which is a large number, even for US standards, of buybacks. Companies buying their own shares. Companies buying their own shares, what do? They essentially artificially sustain the market. So the companies themselves are the marginal investor for equities. So they are buying their own shares with the profit or the cash they have in house. But buybacks don't go in the payout of dividend swap. They are not dividends. They are not dividends at all. So if more companies do buybacks rather than paying out regular dividends, then the actual payout of the dividend swap will be lower. So it's a matter also of willingness, and the willingness is not is more about alternatives to the for returning money to or returning value to the shareholder, and the risk around stocks can be very idiosyncratic. BP, the Macondo crisis or the Macondo disaster. So a gigantic oil spill with costs of, well, I don't even know how large they are, for cleaning up and mopping up all the the pollution that resulted from that, the reaction was that BP had to strongly reduce their dividends for a sustained period of time, because they had to essentially reroute the cash they generated to this cleanup effort. That's very idiosyncratic for a single company, but sometimes the risks are macro. So if you have a credit crisis, that's going to impact everybody. That's going to impact most companies, at least. It's going to impact mostly companies that are more highly levered and have more debt, but it's going to be more systemic. So some of the risks are very idiosyncratic, some of the risks are macro. And you have to, if you want to trade successfully dividends, dividend expectation, you should try to understand both. Nowadays, macro risks, people struggle to identify them, which is typically a very bad sign, because it's a sign of complacency. When you can't see a lot of risks, it's not that risks have disappeared, it's just that you're blind to them. They're just hiding somewhere. So nowadays, people are mostly concerned about idiosyncratic risk on companies when they talk about dividends, and they pay little attention to potential macro shocks. Rewind the clock 6 years, and it was the opposite. People didn't really care what individual companies did. They were all worried about, oh my God, the Eurozone the euro is not going to exist anymore. I had questions like this. So if the euro breaks up, what happens to Euro Stoxx 50? And the Euro Stoxx 50 is the index of Eurozone companies, right? So companies of the 50 biggest companies in the Eurozone. So in Germany, Italy, France, Spain, Netherlands, the Eurozone. So what happens if the Eurozone blows up to the Euro Stoxx 50 and Euro Stoxx 50 derivatives? Who knows? So these were the type of kind of questions that people have. Now, obviously, if you have that in the back of your mind, what type of risk do you assign to a derivatives that might end up being worthless? If the index stops existing, what do we do? Who knows? But nowadays, nothing of this sort is being discussed. I'd like to reiterate a point that I made earlier on the pull to realize or pull to par. So the pull to realized effect is essentially the name that the people give to the fact that the closer you get to an expiry, the more of a dividend future, the more visibility you have on what the companies will pay. Now, the beauty about dividends compared to an equity investment, in a way, you could see it as something that depends on the dividend that a company will pay from now to forever, okay? Plus the terminal value. That's due to a dividend discount model. It's a way to value equities. So, but it's a view that has a very long tenor, if you want. What visibility do you have in 20 years' time? Very little. But if you have a dividend future that settles in 1 year, then you have a very good visibility on what will happen in the next year. Maybe also because a company had told you, I've guided you. We will pay this at least, and we might pay more. So there is still some risk, but it's smaller. So the beauty of the dividend futures compared to an equity investment is that at least the short-dated futures behave quite differently from an equity investment because you have visibility. You have visibility on what the expected payout will be, and there are some risks to this, but if everything goes fine, you know pretty much what you are likely to get over the last when the contract settles. In a way, short-dated dividends are somewhat closer to credit than to an equity investment. because again, you have a good visibility, there's a bit of a discount. As time passes, that discount changes, and then you settle and you receive a certain par value. They are like that. They are not a credit investment. They are like, they have some similarities to it. You can think of it this way, but they are an equity investment. So the point is that there's a stark difference from a short-dated dividend future, where you have this extra visibility, and a long-dated dividend future. A long-dated dividend future, so a dividend future in, say, 10 years' time. So let's say 2028 dividend future. What can we see about this dividend? Absolutely very unclear what will be paid at the time. So the behavior in the interim, the mark-to-market behavior of this very long-dated dividend future will be quite different from the short-dated dividend future. The short-dated dividend future will have a small beta to equities and will tend to be pulled to par progressively as time progresses. The long-dated dividend future will be essentially a completely equity-like investment with a beta very close to 1, because we have no visibility, and therefore the best guess is just what the equity market does. So pull to realize the effect affects the short term of the curve, that it becomes essentially less volatile, less subject to shocks and to equity market changes. And that's an important, that's one of the reasons that makes dividend investment interesting and different from equity investment. Because otherwise one could say, why should we bother with the dividends at all? We have equity to trade. Equity is much more liquid. Why do this? And how can you form an opinion on this? Because I mentioned several times a sort of fair value or expected value. So how do people, and how do I form an opinion on what is the fair value? There's the conventional way of doing this, or the kind of one of the well-accepted way to do this, is to aggregate the estimate of the market consensus. So equity analysts will publish their reports where they analyze companies, and one of the parameters they will comment on is dividend expectation. If you take all the equity analysts on all the stocks that you're interested in, they are part of your index, and for every stocks you average out what the analyst thinks, you get a consensus. So what on average analysts think on that stock. You take that consensus for all the stocks and you create a bottom-up. It's called a bottom-up because you're building it from the single estimates up estimate of for the index level at which you, in terms of dividend points that will be paid. You compare that index level that you obtain with the prevailing market index level, and you find a discount or a premium sometimes, but most of the cases you find a discount. If you deem that the discount is large enough, then it's a good investment. If the discount is not large enough, then it's not a good investment. So in terms of the fundamental side, you have a way to gauge these dividends, and this, at least to get a sort of reference estimate level, a bottom-up estimate for the index, which is something that on the main European indices my team and I do. So, and then if you want to successfully trade the dividends, you have to have a view on, well, this fundamental view, also a view on what will happen from structured products? Is there a lot of issuance? Is there not a lot of issuance? What are other people doing? And on top of, ideally, having a view of whether there are some particular risks that are very high. For example, oil is at 80. All happy days for all oil companies that are paying out a lot of dividends. Is that sustainable or not? So you can take a view on that. It is, we think. But you have to essentially start from a fundamental assessment and then get to the risks around that assessment. And but at the end of the day, what is most important is what the market is pricing, because that's the reference, that's what you have to work with. So these are a few charts of dividend futures from periods from 2017 to the current period. So the yellow line is the Euro Stoxx 50, so it's not a dividend future, but it's actually the equity index. And the blue line is for the 2018 dividends, so the ones that will expire this year. The black line is for the 19s, and the gray one is for the 20s. So you can see a few things. First of all lines go up. It's been 2017 has been an excellent year in terms of market returns, risk on. So people have invested in equities in Europe, and you can also see that the dividends have outperformed the cash index over this period of time, especially the long-dated dividends. The long-dated dividends were, at the beginning of 2017, quite depressed. But now they have rallied so much that my team and I think are actually quite expensive. So we don't think it's a great investment at this stage where they are trading. But we think that compared to the performance of the Euro Stoxx 50, the performance of the dividend has been too strong. But what else can you say about this? You can see some of the effects of the pull to par, because the 2018 dividends are much better behaved. So they have a lower volatility with respect to the longer dated dividends. When there was you can see here the February correction. You can see that you know that we had a big market correction this February, right? So volatility, especially in the US, spiked to very high levels, and there was distress temporarily in the equity markets. So, and the Euro Stoxx 50 over that period of time fell down quite substantially, so about 10% peak to trough. And you can see that the longer dated dividend future behaved equity-like, so they fell also substantially. The 2019 fell by less, and the 2018 essentially didn't fall at all, because they are already subject to the pull to par, and so they are less sensitive to what happens in the equity market. So I mentioned several times essentially the upside. So these are some numbers of actual dividend future for. So on the first column you get the dividend futures. Then JPM is our internal estimates. Bloomberg is a Bloomberg estimate. IBES is a IBES consensus estimate. So these are three set of estimates which are slightly different, but not that far from one another. One is using our own internal analysts, and the other two are two consensus metric. And you can see that the 2019 dividends essentially have no upside left. So they've already been pulled to par. So it's not very attractive to hold these contracts nowadays because there's no juice left, if you want. So, and the longer the contract becomes, the higher the amount of upside that you can get. So the higher the discount of the traded dividends with respect to the expectations. But you're also taking, the other side is that you're taking higher risk. As you've seen before, the dividends have a higher beta to equity markets, and you have more uncertainty. There's more time. You have to hold the contract for a longer period of time. The chart on the other side shows this upside, annualized expected return on this upside over time. And you can see that currently it's fairly low by historical standards for the front year or in the second year contracts. And you can see also that in 2009 it was very large, very, very large. I mean, this is in basis points, but 4,000 basis points is 40%. So it was more than that, so it's like 55% at the point. So these were the days where, what I mentioned before, where people really got excited because the dividends were distressed. We got other periods where the dividend discounts went higher, but not recently. Partly it's a consequence of the maturity that this type of investments have obtained, and partly of the fact that there have been just less distress in the markets recently. It's been a very well-behaved market except for February. So, coming back to the dividend estimates, are they very reliable? Well, they change through time, as all estimates. So, the estimates are based on current expectations from the analysts. So, if new information comes, then the analysts will adjust that expectation. There are some clear trends, at least before the crisis. Analysts tended to revise up progressively through the year their estimates. Following the crisis, so the analysts were too conservative in their expectation compared to what happened. From 2009 onwards, and for a long period of time, the analysts have become too aggressive in their estimates, and they had to revise them down through time. So things turn out to be worse than the analysts expected. And currently, well, they don't really have the latest one, but currently it's much more flatter. So we are not yet in a stage where we are back to positive revision of the estimates, but they are more neutral and so therefore also more reliable. But that's another risk to take into account, if you want, when you're estimating these investments. You know what discounts you have, but the discounts is relative to an estimate that might change in time. And if we are in a distressed market, it's probably going to be revised down. If we are in a booming market, it's going to be revised up. So it's another, if you want, thing to bear in mind when considering this type of trades and investments. And the last few points, and then I mean it's quite early with respect to the time where we were supposed to finish, but I'm close to. I mean, I've almost exhausted the material for these lessons. If you want, we can start on the new one, but maybe let's just wrap up a little bit earlier. So this is the term structure of FTSE 100 dividend futures, which, by the way, currently, in my view, offer better value than the Euro Stoxx 50 dividends, as an aside. So the blue line is the current market. So this is the implied dividend level for expiry 2018, 19, 20. And plus, as a reference, I put the realized levels from 2015 to 2017. So 6 months ago, the contracts, the entire curve was a lot lower, and so the dividends have rallied, and the dividends that rallied the most are the longer dated ones. And actually, this is from about 1 month ago when I submitted this presentation, and it's rallied even more recently. So the curve is not inverted anymore, and it's kind of flat from it's upward sloping till 2019 and kind of flat afterwards. So why do the curves get this inverted shape? So it is a combination of factors that leads to that. Obviously, over the long term, you expect equities to rise. That's a fair expectation. You expect companies to have positive growth. And so you would expect, theoretically, dividends to keep growing. So why is this curve downward sloping at a certain point onwards? Well, there's two main reasons. One is that there's a supply of long-dated dividends, which depresses the implied dividend level, again from structured product. But the second one, and the most important one, is that the dividends that are most interesting to hold for investors are the ones that are shorter dated, because they're going to be pulled to par. So these dividends tend to trade at a lower discount. So you have to bear in mind that this is not a curve that you discount with the same risky rate at each one of the points. The longer dated expectation will be discounted at a higher risky rate. So because they're riskier position to hold, the shorter dated one, which gets pulled to par, the benefits from the pull to par effect, will be discounted at, if you want, a lower amount of risk rate. So the risk premium is higher for the longer dated than for the shorter dated expectations. And here are some other things. So remember, there was very little, the upside on the Euro Stoxx 50 2019 was limited. It's higher on the FTSE. And if you look at the FTSE 2020, you get 15%. Well, it's lower now because they rallied more, but it's more. It's like, it's more. So, and other things that you can look at in order to decide whether this makes sense or not is you can break it down by sector, what the component of the dividend is, because you might think, oh, maybe there's a sector that is really at risk, and this contracts as a massive exposure to that, and so you can do this type of considerations as well. And the FTSE dividends, I mean, these are good discounts, but when we had 3-year stack, they were trading really distressed. So the Euro Stoxx 50 dividends have not been trading distressed for a while. The FTSE dividend were, and this has nothing to do with the referendum, this had to do with essential commodity prices. The FTSE is quite exposed to miners and oil companies, and commodity prices had essentially crashed around 3 years ago, which led some miners to be close to the brink of collapse. And so people were really worried about the dividends from the miners, which contributed a decent amount. So materials is around 36 points. Energy is big. Energy is on the oil companies is 61 points, 61.8 points. So people were really, really worried about this. And so the FTSE dividends traded at a gigantic discount. And that was a very nice trade as well. Because things turned out to be a lot better than expected, and so the FTSE dividends rallied back. And yeah, this is pretty much everything that I wanted to tell you about the dividends. So I will see you actually this Friday for the lecture on volatility products. The lecture on volatility products is a bit more, there's more material, and so unfortunately, even if it's a Friday, it will be a fairly long lecture. But it also is one of the most interesting things, so that compensates, I guess.
Scende per long dated, quindi nessuno sta prendendo in considerazione in questo caso hard Brexit, pound depreciation e quindi dividendi.
Non molto. Allora, prima di tutto, vedi, questo è il pound depreciation. La view sul pound è più bilanciata. Anzi, il pound recentemente si è indebolito un po', ma non per questioni legate alla Brexit, più che altro perché il dollaro è forte. Il dollaro è forte perché prima di tutto si è indebolito troppo, perché le cose sono la storia dei tariffs.
Quindi non c'è. E poi una domanda, perché da un mese fa adesso è diventata più downward sloping, c'è solo questioni di supply e domanda, c'è anche
Da un mese fa, guarda, non so darti una buona, in realtà adesso è ancora più. Comunque sì, intanto non è possibile spiegare non so esattamente.
Va bene, grazie.
I was looking for value in CDS markets. And so,
That is when you have
just keep the index single possible source of
Okay, fairly liquidity. I'm not sure.
Yeah, I'm referring to the dividend index. So if you take your stocks 50.
Yeah, that's a good idea, and actually we do that because we look at you don't only have a market for the index as a whole. You have a market for most of the single market. It's less active than today, but you can see that. You have visibility on the dividend index and the discount of the individual stocks. Unfortunately, it's a market that's wide. So you can think of picking a basket of names that look particularly interesting, but doing relative value against the index, is that what you were hinting to?
More like within the index, within the names.
Yeah, no, that can definitely be
Do you think
well,
it's something statistically significant?
Probably going to go around.
A wild guess, would you think? Does it work? Does it make sense?
it makes sense, but it's not very good.
So
it's not
plus that bar. And that's
It makes sense. Now, from the practicality of actually, so you would want to test this historically.
Yeah.
1100
So you will have some issues with sourcing the data. I mean, it's a good project. It's interesting,
when I count
but it's also a challenging one in the sense that you have to gather the dividend levels, the implied dividend levels for all the constituents, and then find some, in order to get your value metric, you need some sort of historical expectations as well.
Yeah.
If you have a Bloomberg terminal, you can find that. There's a page actually. Maybe before embarking into this, you want to have a look. Just have a look. If you can quickly check.
Yeah.
There's SCEP6, single stock dividend future.
Okay.
That page has a list of all the main Eurostoxx 50 dividend futures. So you can see, you can get the trader level for this. You will see that a lot of them trade only occasionally.
Yeah.
So it's
Discontinuous
not a
data.
market. It's not a market that is the most efficient in terms of price and risk. But and then you will need to get the dividend expectation for all of this, which you can also find on Bloomberg. If you look at the well, you have to get for the company the stock that issued that is linked to the dividend future. You have to get the dividend DPS expectations, and then you have all your data.
Okay.
It makes sense, but it's a lot of data to handle, which is very good. Look, I handle a lot of data. That's as a strategist. That nowadays you do a lot of that. If you're comfortable doing that, it's not a bad idea. Now, in terms of the actual practicality of would you do that in a bank? It would be very niche. It would be like something. Okay, so there's some traders within a Delta One desk. They specialize in single stock dividend futures, but in the banks maybe you have one of these guys or two. In a big US bank, so it's quite niche. So
Is it because it doesn't generate that much?
it's because it's not that liquid.
It's
So
just the liquidity concern. Okay.
it's a liquidity. Liquidity means that there's not that much risk to recycle. I mean, this is a market again that is about recycling risk that just arises from a line of business. So there isn't that much risk that arises from the single stocks. Also, a lot of the single stocks, the dividend risk that is generated by the exotic desk, they tend to proxy hedges with index. So maybe they hold it on rather than recycling it as is. They trade the index against it, so they can do a statistical hedge rather than an outright hedge. But it is interesting. It depends. If you're very comfortable with data, then it shows some. If you want.
I might just do it on the side, not for the project, but just for the curiosity's sake. Anyway,
Sorry.
I might just do it on the side for the curiosity's sake because don't want to risk the liquidity thing.
Is it for your final project? Or?
Yeah, I might stick to the CDS because CDS there's a.
You
bit
can
more-
put it as an aside, as a kind of thing. By the way, you can think of doing this on the dividends if you really want to.
That'd be
And look, there are also some people that look at relative value between, again, it's very niche, free clients that do that, between credit and dividends and single names.
Mm.
Very niche, really specialist stuff. But it's possible. People do that. And what you can do is also look at index dividends versus credit.
Mhm.
Or index option versus credit.
That is even more tough, isn't it?
Yes, but it's very liquid. That's the point. I mean, you can credit on an index, big liquid stuff. This stuff is also liquid. So at the end of the day, people trade what they can.
Okay.
But I think it's a good idea.
Okay. Fantastic.
Yeah.
Thank you very much.
Yeah. Bye.
I'm not sure if I heard it wrong. You just mentioned there is credit risk embedded with dividend future. But
With the dividend swaps, because it's an OTC contract.
oh yeah,
Yeah.
yeah. If the
It's
swap
it's an OTC contract, so you face counterparty risk.
yeah.
But
sure.
the dividend,
But the future, no, right? No credit
no,
risk.
you're facing. You're facing an exchange.
Yeah.
So the exchange,
and you
in
have
theory,
margin.
is very solid.
Yeah.
But
Is there any historical?
no, there's no
Default
historical big default event on exchanges. But on the other hand, if you concentrate, because the margining works if prices move smoothly, right?
Yeah.
So because you are progressively asked more and more and more and more and more. If prices jump like by 50%,
Mm-hmm.
then you will have a massive dislocation in the margin, the amount of money you have for margin versus versus what is theoretically owed. So there still is that. It's called a gap risk, the risk of a very
Gap
large
risk.
sudden move. So an
Oh,
immediate
so-
move, like the market closes today and today is open down 20%. That risk of a big jump, right?
Mm-hmm.
It's extremely unlikely.
But it's still possible.
But it's still possible.
Yeah.
So in theory, an exchange could be insolvent. In theory,
Ah, I see. You
But-
mean the
but-
balance may be below zero
yes.
within the day?
Yeah,
Ah, yeah.
yeah.
Probably, yeah.
In theory, it could,
Yeah.
but
makes
it's
sense.
generally considered as much less risk.
Ah, I see.
Yeah. So
I see.
but
Mm.
yeah, no. So
Makes sense.
generally, people say, okay, fine, you don't have counterparty risk, or your counterparty is the exchange,
Yeah.
and your risk is very minimal.
Uh-huh. Ah, makes sense.
Okay,
Thank you very much.
it's not a problem.
Thank you.
Hi, thank you.